The S&P 500 is starting to look expensive. When we are looking at it on a forward P basis, we can see the majority of the companies are trading above 25. We have the likes of Microsoft 31.5, Amazon 34.5, and as we can see, there are very minimal stocks now that are looking fairly undervalued with an attractive forward PE. Also, when you do consider the fact that the S&P 500 on a forward basis is now around 20.87, we are starting to see that more and more companies are trading higher than this. And when we do factor in fact, quarter four of 2023, it did go as high as 27. It is now trading lower at around 20.87. So in today's episode, we are going to take a look at 5 overvalued dividend stocks. Now, we do want to add these into our portfolio, so we will get to our own target price. For each one of these, we are going to look at the intrinsic value and what we believe to be our acceptable price. Now, in this episode, some of these stocks we do already hold, so we will explain when we will be looking to re-enter and add more to the portfolio. We're also going to go into some detail in each of these companies, not just focus on dividend safety, but take a look at a lot of the metrics, why we like these companies, the increasing free cash flows, the reduction in the shares outstanding through share buybacks, as well as the dividend growth, so you understand what we're looking for when entering into any company within our own portfolio. And for those that don't like to pick individual stocks, in today's episode, towards the end, we are going to focus on an ETF, the SPY, which does in fact track the S&P 500. We're going to run through some information, their top holdings and how their performance has been as a consideration for an alternative to these companies that we are reviewing today. So let's jump off with the first stock that we want to add to the portfolio but does look to be overvalued. It is the Home Depot, ticker symbol HD. Now, this is a company that is in fact up 18% over the last 12 months. When we look at it, it has had some pullback. It is now in the midpoint of the 52-week range. It does have a forward yield of 2.62% and a forward P sitting at 22.32, and that is above the average of the S&P. We note Wall Street do, however, consider this a buy, with the other two analysts giving this a hold rating. Now, over the last 10 years, it has had some strong performance. Excluding dividends reinvested, it is up 345%. Now, in terms of looking at the metrics, straight away, dividend safety score 87. It is very safe. Market cap 340 billion. It is a mega cap company. Now, in terms of the last recession, well, they did maintain the dividend. They didn't increase it, unfortunately, but they also didn't cut it. They had average growth at negative 11%, and they also marginally outperformed the S&P, negative 44, with the S&P clocking in at negative 55. One of the things that we like with Home Depot are those dividend increases. Now, we do note it was a little bit lower this year in relation to how they previously have increased it at 7.7. Nonetheless, strong and above the average inflation rate over the US at 4%. So you are getting an above inflationary increase. Over the last 5 years and the last 20 years, double digits, looking very strong and healthy. And we can see they have been increasing those dividends for the last 15 years, whilst paying a dividend for the last 36 years without a reduction. Now, in terms of dividend yield theory, now there will be new viewers. Essentially, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. So you could argue slight undervaluation, but when you incorporate the forward P sitting near the 5-year average, this does look like a sign of reasonable valuation. And when we do look at it in comparison to the sector P, consumer discretionary does sit much lower. And do remember, we don't look at any of these models in singularity. We will conclude towards the end. Now, it's important to understand we do prefer focusing on free cash flow metrics throughout our analysis and our research. The earnings is susceptible to manipulation by management through accounting, and we do have a blanket rule of 60% or lower. Now, the main reason for this is if we do believe it is below 60%, it means it is more likely that the company will offer those double-digit dividend increases we love to see. With Home Depot, we do note it did breach that once in 2023. FY24, it came back lower, and we can see next year it is projected to be around 56%, still below the 60% level, so we would expect a nice dividend increase. Free cash flow per share, we do note increasing free cash flow more than 3 times growth over the period, although a little bit inconsistent as we can see, and we do want to point out FY25, they are expecting a little drop to that free cash flow. In terms of their sales growth, now we do anticipate 3 to 7% as a healthy amount for the majority of companies in the bracket of steady moderate growth. We can note they pretty much hit that over the last 10 years, although we can see FY24 negative 3% to their top line, and we can see numerically speaking they have nearly doubled it over the last 10 years. One of the things we really like about Home Depot is the fact they do a lot of share buybacks. As we can see, they bought $350 million worth of shares over the last 10 years, effectively increasing that cash to those shareholders through giving you more portion of the returns of the company. Now, in terms of the ROIC, a very important metric, we want to see a minimum of 10% to give us faith that management are able to effectively allocate their capital, and we can see they've done that pretty consistently over the last 10 years. So that is a very strong metric that I would advise you to incorporate into your own research and analysis. Margins consistently very healthy, above the 12% minimum we want to see, 14% in 2024. And on the free cash flow side, again, looking very strong, 12% in the more recent year, above the 5% minimum. Now, net debt to EBITDA is another very important metric, as this does correlate to both dividend safety and balance sheet. The EBITDA standing for the earnings before their interest, their tax, their depreciation, and their amortization. And below 3 is the general target. Again, a blanket rule for this metric for the majority. And these are the number of years it would take the company to pay off all of their debt net of cash on hand. In fact, it's been below 2 every single year. 1.84 in the more recent year, expected there or thereabouts in FY25. Now, let's jump into the valuation, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And on this channel, we do a lot of deep dives into other companies, but for today's episode, we're going to jump straight into the final calculation. And for today's episode of the Home Depot, the intrinsic value is coming to the average of these two models at $385. Now, on this channel, with the essential margin of safety, what we use is 10%, and we really execute on that if the company has a wide moat, strong financial metrics, and good forward-looking data. And that does come down to the individual investor's risk profile. Now, 10% would be essentially a buy at the current price, around $347. For us to really look at a company where it has a lot of value and to add it to the portfolio rather than invest in an ETF, we do like to see a much larger margin of safety, at a minimum around 20%. Now, for those who are looking at 15%, it would be a buy around 327, at 20% around 308, and this is where we would start to allocate a position. Now, this is the first stock we're reviewing today. It isn't one we do hold directly, but it is one we would like in the future where we do see value at around that $308 mark. Now, when we do take a look at the historical performance of Home Depot, we can see that it's still within the 52-week range. So it is something that we do believe is achievable and something that we could see over the next 12 months. And therefore, this is one that we will be looking to add into the portfolio. Now, in terms of Wall Street and their forecast over the next 12 months, they see this to have upside of 13%. We can see there their forecasted price of $386, pretty much in line with our calculated intrinsic value. As always, do let us know your thoughts on these stocks as we go along. Do drop your comments below. Now, also, just to let you know, we have released our latest free weekly article where we do run through 10 stocks with significant upside. If you want to gain free instant access to any of these articles, click on the pinned comment below and you can start reading straight away. The next stock that we do want to add to the portfolio, it isn't one that we have a direct position in right now, is ADP, Automatic Data Processing, not to get confused with APD. This is one that is up 13% over the last 12 months. Over the last 10 years, strong performance up 261%. We can see it is in the upper end of the 52-week range, with 2 out of the 3 analysts considering this a buy, Wall Street themselves a hold. We see the forward P 26.72 above the average of the S&P and a forward yield of 2.3% and a market cap bang on around 100 billion. So in terms of dividend safety, a very safe score at 97, market cap 100, mega cap therefore. And we can see in the last recession, they increased the dividend. They had above average growth, -3 versus the S&P -12. And we know they significantly outperformed the S&P, -29, with the S&P coming in at -55. Dividend growth, again, double digits last November, double digits over the last 5 years, double digits over the last 20 years, a strong dividend growth company. And great news, they are 1 year away from becoming a dividend king. They are soon to hit that 50 years of consecutive increases, and we would be surprised if they don't continue that trend moving forwards. We now get a sense of, again, small undervaluation on the dividend yield theory. Forward P as well, not too far off that 5-year average. But when we do compare it, it is much higher than industrials of 19.7. So looking at the free cash flow payout, we do want to see 60% or lower, and it has straddled along that pretty much consistently. Nice to note, 2024, it is expected to drop down to 45%. Hence, we would be surprised if we don't see a double-digit increase to their dividend this year. Free cash flow per share as well, it has nearly increased 3 times over the last 10 years. It is increasing, although marginally year on year. 2024 expected to be a very strong year of growth as well. In terms of the sales, well, a lot better than Home Depot when we did analyze that, because it is positive every single year, with the last 2 years at double digits in 2022 and 9% in 2023, looking very strong for this company. Numerically speaking, then, they have increased their top line by 80% over the last 10 years. And similar to HD, we also see the share buybacks consistently year on year. Now, in terms of the ROIC, not only is it very strong, but it has been increasing a phenomenal 64% in FY23. That is very attractive to potential investors as well. In terms of the operating margin, we see very strong operating margin, 18% in 2014. Operational efficiency as it does increase over the longer term, and we note the free cash flow margin very strong and healthy, 20% in FY23, and that does seem to be very consistent across the years. I mean, very, very strong balance sheet. Dividend incredibly safe, 0.28 in 2023, 0.31 in 2024. This has got to be one of those that you do consider for the portfolio. So let's jump into the valuation. Don't forget as well, you can click on the pinned comment below if you do want to grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list. So margin of safety then, we do start off with that 10%. We can see a buy up to 253. At 15%, not quite there just yet. And as we mentioned, it is something that we would like to see around a 20% margin of safety at $225. Now, when we do compare that to their 52-week range, we can see that is still within the 52-week range. It is something that we do believe we will see over the next 12 months as well. So we do believe it to be a reasonable target. But right now, as we mentioned, it does have between a 10 to 15% MOS level. In terms of Wall Street and their forecast, well, we can see very minimal upside based on the current value, price target of $260 with upside of 7%. And as always, do let us know your thoughts below. Now, the next dividend stock is one that I do in fact hold directly, and it is CNI, Canadian National Railway Company. We can see straight away just one of the 3 analysts considering it a buy, with 2 considering a hold. Over the last 12 months, up 6.4%. Over the last 10 years, up 127%. We also note the forward PE 22, not too far off the average of the S&P, with a yield trailing 12 months sitting at just under 2%. In terms of the dividend safety, again, like for like with ADP, 97 score, very safe. Market cap, 82 billion, a large cap company. Now, recessionary metrics, they in fact increased the dividend in 07-09, average growth, and they marginally beat the S&P with that negative 45%. Very nice to note, 7% increase in January 24. However, over the last 5 years, as well as the last 20 years, we did see some very strong double-digit growth to the dividend. And we do note they are a dividend aristocrat. They have increased those dividends for 25 years or more. In terms of looking at dividend yield theory, well, again, we do get a sense of reasonable valuation with the yield near enough in line with the 5-year average, and the same to be said with the 5-year forward P, not too far off at all. And again, the industrials as the sector P is slightly lower at 19.7. So when we take a look and compare it on the free cash flow payout, below 60% pretty much every year, and in 2024 it is expected to be around that. So we do quite like, even as a bare minimum, high single-digit growth to the dividend. Free cash flow per share, it has been increasing, although we do note the last 3 years it has remained fairly flat. FY24 expected to be more of the same, so something to consider when you do look at your own margin of safety and investment thesis. Terms of sales growth, well, very cyclical. We do see some strong years of double-digit growth, years of negative growth, and so on, and the trend seems to continue. Last year wasn't the greatest with a negative 2% to their top line. Terms of numericals, well, we do see they have increased their top line, but do understand this isn't a tech company. Don't expect large, rapid growth year on year. What is also very nice to note is the fact that they do a lot of share buybacks and consistently year on year, as we can see from the graph on the left. Now, in terms of the ROIC, and what I would say is while you are watching these episodes, do take note at a lot of these metrics, why they do look to be very strong for different companies, and then put them into companies that maybe we don't cover or haven't covered as often to see whether or not you do believe that they do meet those criteria. So ROIC, we can see consistently around the 14 to 16%, so very healthy for this company, and the operating margin very, very high, around the 40% nearly every single year. The same can be said for the free cash flow margin as well. Lots of consistency and some very strong numbers on both margins. Very, very strong to see as an investor. Net debt to EBITDA as well, very healthy, below 3, 2.16 in 2023. It did increase slightly from the previous year, but it is noted to drop down a little into 2024. Something just to consider with railways. They do have a fair amount of debt, but it does look like that net debt to EBITDA metric does look consistently healthy. In terms of the valuation then, let's get straight to it. The intrinsic value in today's episode is arriving at around $136. Now, when we take a look at the margin of safety at 10%, we do note it isn't a buy, it doesn't even have a 10% margin of safety. So right now we see between 5 to 10%. In terms of a 15% margin of safety at 115 and a 20% margin of safety, we do see around 108, where that is the last time I did add it was around that level. Now in terms of 108.61, when looking at the historical performance, we can see that is near enough that 52-week range or towards the 52-week low. So that is where I will be looking to add more to my current position of CNI. Now, in terms of Wall Street, looking at their forecast over the next 12 months, again, this isn't one that they see massive upside. They have 4% as their target with the price of $133. Do let me know if this is one you hold, or maybe you do prefer other railroads in the industry like Union Pacific or even Canadian Pacific. We then move on to a massive beast of a stock that is Costco Corporation. Now, this is one that is up 53% over the last 12 months. Over the last 10 years, up 627%. Now, it is trading towards the upper end of the 52-week low. Now, whilst it does have a trailing yield, or forward yield, in fact, of 0.63%, do understand they do pay a lot of special dividends every few years. So if you were holding, your true yield would be a little bit higher. And we do know one buy out of 3 from the analyst, and a forward P looking incredibly expensive in comparison to the S&P at 46. And yes, we do understand before people start commenting, you can't compare all the stocks to the S&P average, but it is something we are just doing for consistency as we have done with the stocks so far today. In terms of dividend safety, well, the highest score obtainable, 99, very safe. Market cap, 324 billion, a mega cap company. In terms of the key recessionary metrics, they increased it during the last recession, above average growth, and outperformed the S&P with a negative 38% return. Dividend growth, well, they did increase it just, in fact, a few days ago, 14%, 12% on average over the last 5 years, and 13% on average over the last 10 years. And they have been increasing those dividends for the last 19. Now, in terms of looking at that special payout, as I mentioned earlier, they did pay a 15 dividend per share, in fact, in January the 12th of this year. In terms of looking at that undervaluation signal, well, in fact, we do have an overvaluation signal per dividend yield theory with the yield below the 5-year average, as well as the forward PE significantly higher than the 5-year of 35.7. And no surprises, consumer staples sector PE is much, much lower. In terms of the free cash flow payout, consistently low every single year, bar 2016. 25% in 2023, expected to go up slightly higher in 2024 at 32%. Free cash flow per share as well, it has increased, although a little bit more inconsistent. Nonetheless, it does improve over the years, 15-20 in the more recent year, a small drop expected into FY24. Sales growth, well, no issues. In fact, pretty much higher than the minimum we want to see year on year. 7%, one of their lowest years in the more recent period in FY23, but we still can see they have increased their top line more than double over the last 10 years. One thing we would say, a little bit of a shame, is that they don't do a lot of share buybacks, as we can see, very minimal. In fact, over the last 10 years, they have increased those shares by around 2 million. In terms of ROIC, very strong, very healthy again. The last few years in the mid-20s, 23% in FY23. And looking at their operating margin, we can see it doesn't become above the 12%. In fact, 3 to 4% over the last 10 years. But they also do a lot of memberships as part of their income stream. And if they do in the future wish to pump up those top line, they will as easily as just increasing their membership fees to their customers. We also note the free cash flow margin does lack a little bit, so there are one or two metrics here that maybe not stand up to the others that we have reviewed, but one of the best balance sheets, a very strong balance sheet strength, in fact 0 in FY23 and the last few years, expected the same in FY24, no worries as well with that dividend, hence the balance sheet. So in terms of the valuation of Costco, let's jump in. And don't forget to smash that like button if you do enjoy today's episode. Hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, as we can see, an interesting case here. Now, we have the intrinsic value lower than the current price, so we do believe it is currently trading at a premium. Now, this is one that you may argue you're happy to pay the premium or a lower margin of safety. At 5%, a buy up to 683. At 10%, around 646. And at 15% around 610. Now, given this is a fairly high quality company, they also do a lot of special dividends over the last few years. This is one that personally I would be happy to add at a 10% margin of safety, around $647. And when we do look at the historical performance of Costco, we can in fact see that is around the midpoint of the 52-week range. Now, personally, as I mentioned earlier, this isn't one that I do hold, but it is also one that if it never comes down to a price where I do believe there is some nice value, I will not be worried about adding this to the portfolio. I can move on to a lot of other quality stocks if and when they do hit those buy prices. In terms of Wall Street, over the next 12 months, they do see upside of around 6%, so very minimal. Again, we're talking single digits with a price target of $773. Again, you could argue this is a high quality company, so you could just dollar cost average in every single week or every single month. In fact, that could apply to a lot of the stocks we have reviewed today. So also let me know if that is maybe your strategy, which isn't also ultimately a bad one to have. The next overvalued dividend stock that we have is Mastercard Incorporated. Now, this is up 29% over the last 12 months. Over the last 10 years, a very strong performance, up 528%. Remember, it doesn't include those dividends reinvested. It is towards the upper end of the 52-week range with a forward yield of 0.57%, a forward P at 32.34. And we can in fact note in today's episode, we do have a strong buy, even though we do believe it is overvalued. In fact, we also have another buy and one hold. When we take a look at Mastercard, again, a very safe dividend score of 99, 434 billion. It is a mega cap company. Last recession, ultimately, they maintained the dividend. They didn't increase it, but they also didn't cut it. They had above average growth and a very strong recession return at negative 12%, one of the best that we have reviewed on the channel. Again, a common theme with the majority of these stocks today, they do have consistently double-digit dividend increases every year. And we note for Mastercard that they have 12 years of consecutive increases with 17 years of paying a dividend without a reduction. Now, in terms of dividend yield theory, we again have a reasonable valuation with the yield in line as well as the forward PE. But when we do compare it, financial sector does sit significantly lower. No worries to note, to be honest, in terms of the free cash flow payout, pretty much around 20% every single year, again expected in 24. It would be a shock if we do not see another double-digit dividend increase for this company. Very nice growth on the free cash flow per share. Nearly every single year we see strong growth. FY24 expected to be more of the same, up to 1330. Sales growth bar the justifiable COVID year, very strong growth. In fact, a lot more than the minimums we want to see, nearly double digit every single year, which has meant they've managed to increase their top line at a very rapid rate, nearly 3 times over the period. On top of that, a lot of share buybacks, as we can clearly see. So they are returning excess cash and not just through those dividend and dividend increases. ROIC as well, very strong, very consistent, 61% in FY23, which wasn't even their highest year as we can see in 2018. So that is a lot to add and to put into your margin of safety as well as your investment thesis. Margins, phenomenal, consistently phenomenal as well. Free cash flow margin, again, the same to be said. So no real red flag indicators. And we're looking at a company with a phenomenal balance sheet. 0.47 in FY23, 0.42 expected in FY24. So again, this is definitely one to consider once it does come back into a sensible valuation. Remember as well, you can grab a copy of this model by clicking on the pinned comment below, where you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list. Margin of safety then, again, 10%. We in fact do see it as a buy if that you believe that is sufficient. 15% up to 448, so not quite there yet. And again, in my personal view, a 20% margin of safety. This does look to be a buy around $422, where I will add this to the portfolio. And this level, when looking at the historical performance of the company, we can see it would be around the midpoint. So it is one that we could see over the next 12 months. But as always, we don't have a crystal ball, but we do have our prices that we would be happy to add if the company does continue to stay strong. In terms of Wall Street and their forecast, well, over the next 12 months, they have a price target of $515. So whilst they do see it have upside of 11%, it isn't as much as maybe you would like to see from these type of companies. But again, as always, interested to hear your thoughts below, and we will get back to you and give us our thoughts and perspectives too. Now, in terms of not looking at individual stocks, if it is something you want to do and you just want to dollar cost average in to an ETF, well, this is a very strong ETF to consider. It is the S&P 500 Trust, which is from SPDR with the ticker symbol SPY. Now, this expense ratio isn't too bad, 0.0945%, and again, this does essentially track the S&P 500. If you want to take a look at their holdings, well, we can see their largest holding here is Microsoft Corporation, 7.29%. Third place, we have Apple at 5.82%, and making the top three, it is Nvidia with just over 5%. Again, this really does depend on your own risk profile, your investing goals, and as I have mentioned quite consistently over the last few episodes, my personal approach to investing is to hold a portion in ETFs and then look at individual stocks when they do become of value around a 20% margin of safety. In terms of looking at the performance over the last few years, well, year to date around 10%, over the last year 29%, as we can clearly see. And if this is one you have been holding over the last 10 years, what you would know is that you would be up every single year around 12 to 13%. If you want to go far back to the inception, we do see around 10.3, 10.4%. As always, though, do let us know your thoughts in the comments below. Maybe you do also like adding ETFs. Maybe you prefer solely to look at individual stocks, or maybe you have a completely different strategy and go all into Bitcoin. Anyway, as always, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.